Hello and welcome. As we get ready to close out the year 2022 and ring in the new year, I want to take a moment and thank all of my clients and the firms that have trusted me with their trading software needs. I want to wish you a very happy, healthy, successful, prosperous, blessed new year. Thank you for your patronage and thank you for trusting me with your trading software needs. I also want to jump in and cover what happened this year and what my personal prediction, in my opinion, is going to be in the year 2023. I think we're going to see some significant shakeup in the entire industry, the money management industry. First of all, let's start with some recent history. So in the year of 2021, as we closed out that year, as we're getting ready to close it out on, I believe it was December 8th or 9th. In fact, it was first published on the 8th of 2021, and I guess updated the next day on the 9th. These firms, these are the Wall Street elite, okay? These firms made a prediction as to their SPX or S&P 500 price target for the year 2022. Credit Suisse, 5,200. Goldman Sachs, 5,100. JP Morgan, 50-50. RBC, 50-50. Deutsche Bank, 5,000. You'd think that when you look at these numbers, have these people been in like a chat group or something, or a text group? In any case, we have Citigroup, 4,900. I don't know if I said Deutsche Bank, 5,000. Barclays, 4,800. B of A, 4,600. Morgan Stanley, 4,400. So we can say these two banks, B of A, I used to work for these guys, and Morgan Stanley, they were the more bearish, on the bearish side, at 4,400 for at least Morgan Stanley. And how did we end up? 38, 39. So the Wall Street elite, these are people, and I kid you not, where certain pension funds, particularly the smaller pension funds, hope that these guys will take on their accounts. Their hope is they're willing to pay exorbitant fees so that these people will manage their money for them. I personally spoke to the chairman of the board of a pension fund in the state of Florida. I don't want to give details on the fund because it'll become obvious who they are. It's a smaller fund. They manage $400 million. And the gentleman had flew, he's a CPA himself, he had flew from Florida to Vegas in 2019 to attend the SALT conference. And I asked him, why is he there? And he said, well, because he's got a hedge fund, one of these guys. Actually, they're not on this list, but they are on the top 20 list of hedge funds. And he said that they are not returning his phone calls. And they keep taking his messages, but they're not calling him back. And so he flew all the way out to Vegas because he knew that fund was going to be there at the SALT conference and that they were taking meetings. And so he got his name on that meeting list so that he can finally meet with them. Think about that for a moment. Imagine parking hundreds of millions of dollars with a firm and you can't even get a phone call back because they think you're too small. So they don't want to waste their time with you because you only have a few $100 million with them, okay? This is the kind of industry that these elite, the Wall Street elite, are in, okay? People literally will stand in line, will hope that these guys will manage money for them. So this is the type of price targets they had. They missed it by a lot. All of them did. Even the ones who had a slightly more bearish overtone, Morgan Stanley and B of A, they missed it by a lot too. This goes to show something, that no one knows what the future holds. These guys are managing a ton of money, a ton, okay? And they got it all wrong. So they can essentially, as I jokingly said earlier, that these people are on some sort of a chat group or like a Facebook group or something where they're all pretty much in line, except these two maybe are the outliers, but these guys are certainly in line. And you would wonder, like, how could they all reach pretty much the same consensus, right? Like, how did they get to that 5,000 mark, for example? So this is something that, there is a rule, I should say, that usually whatever your current price target is, the sort of rule of thumb for these guys, these analysts, is to add 20% to that number. Okay, that's usually what they do. But if that's all they're doing, why is anybody standing in line or even wanting to park their funds with them? Because if they have no actual way of determining what the potential forecast is, at least let's say within, let's say, a 3 or 5% variance between their price target and where it ends up, you would be okay with that. But they are completely off. They got it completely wrong. Well, if that's the case, here's my prediction as to what's going to happen going forward. I'm already seeing this myself in my own firm, where people with money, individuals with money, serious money, 1 million and up in excess capital that they can put into the market, are not only wanting to develop their own systems, in-house systems, but they're also, some of them are considering starting their own funds. What I think is going to happen going forward, not necessarily just in 2023, but going forward from 2023, I personally think that a lot of these guys are going to see these guys and a bunch of others that are on that top 20 list are going to see a significant exodus of funds leaving them, of pension funds and moneyed individuals, ultra wealthy individuals leaving them. Okay? Those people are going to want to move trading operations in-house. I think that is where this market is headed, because why pay these people? On average, you're going to be paying them about 2 and 20. Now, the most elite will charge even more. There is a firm not on this list that charges as much as 60% for performance. Okay, they are not. They barely made money this year. So, but they're still charging 60% just because they're famous and they're known in the industry. They can get away with that. Why pay anybody 20% performance fee or a 2% management fee? In this case, nobody got paid their performance, most likely, but they all got 2%. So if they're managing $1 billion, 2% of $1 billion is a lot of money. Why give anything to someone who is essentially not going to make you any money? The right thing to do would be to move those operations internally, those trading operations, build their own systems, and be able to trade themselves. Now, further, I believe that we've already seen in the year 2022, it's been a systematic day traders market. It's hard to argue with that fact. Those who were day trading systematically, meaning they removed emotions and emotional mistakes from the equation for the most part, and they relied on minute bars as opposed to daily bars to make their trading decisions, and they essentially automated the process. They, for the most part, did better. It has become a systematic day traders market. One can even argue that as soon as the meme stocks became popular, where retail was able to thwart the plans, if you will, of smart money, quote unquote. Okay, I have smart money in quotes. Just imagine me doing air quotes. And they were able to essentially put some of these hedge funds out of business because they were able to subvert the paradigm, if you will. There was a major shift in the paradigm where retail was able to do something for the first time, as long as I can remember, to affect the outcome of hedge funds. Smart money essentially has always, when I say smart money, always imagine me putting it in air quotes, those hedge funds have always looked at retail as easy picking or low-hanging fruit. Okay? If you want to take advantage of a system, you just look at what retail is going to do, and of course you can buy that data, and you just get ahead of them. It's pretty simple. Okay? Moreover, even if you don't have that data, you can get ahead of them because retail has been taught so many things via YouTube videos of non-really professional traders that have put out videos as to what to do. For example, look at a support level and look at a resistance level. And if you're long, then put your stop somewhere below support. And if you're short, then put it somewhere slightly above resistance. Well, when you do that, if all of the orders or 95% of the orders seem to be below support and prices moved above support, it doesn't take a genius to figure out that most of those orders are stop orders, right? And if the market has $100 million of activity in it, let's say during the initial hour, RTH open, then if you have $2 billion at your disposal and you just short the market, let's say $500 million, okay, you will take the price down, take out all those stops, and now you can buy another $500 million or another $800 million and go long and now take the price up that way. You just took out all those stops. Easy picking, as I said. But retail is learning, okay? Retail is learning as they're building systematic tools, turning to professionals like myself and others in the market that are licensed, systems developers. I'm licensed CTA, and I'm also a systems developer. And so if you turn to people like myself and others and build smart systems yourselves, then you have a tremendous advantage in what we are currently experiencing and we're likely to experience going forward, that being a systematic day traders market. Now, value investors, when they hear this, something happens to them, right? Like this anger bubbles up and it starts to come out and spew out. Well, as much as I respect value investors, I myself think of my own long-term portfolio as a value investment. But that's a 20-year outlook. If you're trying to make money each year, it's going to be very difficult to park your money and wait. If you did that, I mean, this is the kind of targets the professionals had, okay? So they missed it by a lot, okay? This is where we ended up, 38, 39. This is the kind of predictions they made, all right? Nowhere in the same vicinity. And so you really have to see that as a potential outcome. I mean, these predictions were so bad. I should note that Fortune wrote an article about them in October, how the best minds on Wall Street got 2020 stock market so terribly wrong. Okay, and so this is just a statement of fact at this point. If they're going to get it wrong, you have to ask yourself, why would moneyed individuals, people with millions and millions of dollars of excess funds that they can put it into the market, or pension funds, that's the real heavyweights, okay? Why would they continue to park money with these guys? I understand that they have their due diligence and they have to park their money with people that know what they're doing, but these people obviously proved that they don't. The truth is, this is their predictions. Yes, they made several revisions throughout the year. Every time they got it wrong, they made yet another revision. And even those revisions are wrong. The most recent revisions that they have, those are wrong. Okay? So they're just not able to get it right. And this proves something, that a lot of people have the means to build their own systems and bring it internally. So they have full control of what's going on. Pay once for a system like that. And even if you have to maintain it once in a while, you just pay for that maintenance and you're essentially done. You don't have to keep paying these guys money year after year. If they make you money, it just goes to prove that on the years where they made money, it's easy money to be made. So on those years, you're essentially throwing money away. Okay? They're paying 2 and 20, 2% for money management, 20% for performance, for essentially nothing, for people who were literally throwing darts on a dartboard. Okay, so that's where the value investors have a point. That's where serious investors like Warren Buffett, when he says he takes on the hedge fund industry and he says, look, a monkey can do a better job than these guys. He actually, at times, not always, but at times he does have a point. Okay, because essentially a monkey throwing a dart could have gotten lucky too, just like these guys did. And so, and I know I'm being rough with them, but you would think for all of the, collectively trillions that they're managing, that they would have better insight as to where the market might go, but they don't. And that's a fact. We can see that. And so this is why I believe, let me show you guys something. So this is what we have in the US. We have almost 19,263 individuals just in the US. We're excluding majority of the world now, okay, the population of the world. We're excluding Europe, right? We're excluding all the money in the Middle East. No, let's just focus on the US for now. There are 19,263 individuals that have $100 to $500 million. And it is approximated that about half of those have family offices. What that means is a family office, to those who may not know, a family office is essentially a rich, well-to-do family that has put together a legal entity, a family office, and they have essentially put, generally speaking, the leader of the family or the person most experienced in the market. Sometimes that could be like, a son-in-law of the guy who started the business, okay? And that guy, he's a stockbroker on Merrill Lynch, so they say, okay, you handle our money. They put that guy in charge of the funds that they have in that family office fund. So the family might be making something like 100 or 150 million dollars a year, and each year the family is deciding to put, let's say, 5% of that into the family office fund, and they want to put that capital to work. Okay, and they hire, or they can hire an external manager of their money. Sometimes they do that, by the way, and there's a lot of firms that just specialize in that, where they not just handle the money, but they also handle business elements of the family office as well. They handle the attorneys, they handle the logistics, if you will. But at times, the family office is really serious about investing. A lot of these family offices tend to put their money in real estate, commercial real estate, it doesn't matter. So in some sort of properties, because they've seen that business does well over the years. But because of what the situation is like in real estate as well, a lot of these guys, again, my prediction is that they're going to be looking for internalizing the trading operations and putting focus on that. Because if you were day trading this year, chances are you might have had the best year you have ever had, okay, in the history of you trading, if you've done it right. And so that is why I believe that there's going to be a lot of firms, a lot of family offices that bring in operations and they pull money out from these guys, okay, and bring it to internal operations. Now, some of these family offices will realize that there is zero reasons for them to not start their own fund. Now, a lot of people have done the research on what it takes to start a hedge fund, and you'll see that it just won't take time, but it takes money too, okay? It doesn't just take, a year or two to get everything situated with the paperwork, but it also takes a lot of money. However, there is a way to make that process so much more inexpensive, so much cheaper, and make it so much quicker as well. And that's by starting a CPO or a CTA fund, okay? So a commodity pool operator, for example, can start on like $1,000 or around there, $1,500, and essentially be able to manage money for people. You just have to get licensed, which is a simple test that one can take. And once you pass that test, you can join the NFA and become a commodity pool operator. And so starting your own commodity pool fund or becoming a CTA and managing funds for people is a way for these family offices to generate income. So once they test and they see that they can themselves, with their own money, make money using systems that they pay for and or develop internally, then they're going to start their own firm. So I do see a massive growth happening in the industry of smaller funds managing money and taking business away from these guys who are unable to perform for their clients, okay? They can have 1,001 excuses, and you got to listen to these guys when they make the excuses. I mean, bring out your dictionary, okay, because they're going to use the biggest words that they know to make themselves look very, very intelligent. And in doing so, some of those people will buy what they're selling, but the truth is they missed it completely. And so when they do that, people lose faith in them. Okay, this is not we can argue Morgan Stanley was only 600 points up. Okay, so these guys, it's pathetic, right? It's not even in the same vicinity as, and look, we have Goldman Sachs, Credit Suisse, JP Morgan. These are big investment banks. These are people that are managing, trillions of dollars, okay, collectively. And so this is a big problem when they get it wrong. Now, I'm not going to argue that, it's going to be a mass exodus that's not going to happen. But I see my guess would be somewhere between 10 and 15% of funds that these people manage leaving them. Specifically the rich individuals that had parked with them, and they were more than happy to do that. I think they're going to leave. Certainly some of these people will leave, the ones that have in the U.S. more than $500 million, and that's about 1,100 or so people here. And so that's about 10,000 plus offices, according to FamilyOffice.org. They're estimating that exists. I would say that's probably about right. It's right around that vicinity. Now, I know personally people that have family offices that haven't really used it. They've set up the entity, but they never really used it, only because they had no one to actually manage all of the operations. So they do, like, once in a while they dabble in real estate investments, and they really don't have more than like $50,000 or $100,000 exposure to the market. I see that changing. I see the exposure going closer to about $1 million in the market that I think a majority of them will be able to come up with, as opposed to investing in real estate. I think that once they build their own systems, they can have something that can potentially generate income from them for years to come, and do that in-house without having to pay any management fees or anything like that. Especially if you're running it systematically, you're supposed to trust the system that you've developed and let it go, do its thing. And so I do believe that that is where we're headed. If my firm can be of service to individuals that have $1 million or more that they can put into the market, for that $1 million, some of that will go into development. Some very small portion of that will go into getting set up, and I can certainly assist with that as well, setting up the fund, direct you as to what you should do so that you can set up your own either CTA fund or a commodity pool operation, so that you can have the cheapest way to get in to the money management business, and set all that up for you, or assist you in setting it up, and direct you as to what you need to do as far as your auditor goes, as far as all the little logistical issues that need to be addressed. But it's not a big deal. It's really easy to start it versus starting a hedge fund. That's a lot more involved, and you will assuredly need an attorney to set up a hedge fund. So I would not recommend starting a hedge fund because of the costs involved. And I believe that in this market, it's not going to be the best option. I think is not going to be stocks or equities. I think it's going to be commodities. As we've seen, a lot of money is potentially being made or lost, but those who made it made a ton this year in commodities, whether you're trading ES, NQ, crude oil, SCL, natural gas, NG, GC, gold, SI, silver, or bond futures, ZB, or some people are trading the agriculturals, you're trading wheat or corn, ZW, ZC, etc. Whatever it is that you're trading, commodities seem to be the best way out. And commodities, remember, have tax advantages over trading stocks. Moreover, commodities, particularly derivatives, the futures, have that was the purpose, right? The intent was for people to be able to speculate and or to hedge. So stock market investing, as they call it, is that you're supposed to invest and think the way Warren Buffett thinks. If you have that kind of money, you just want to invest it and let it go, sort of like Warren, then that is probably the right way to go, based on what we've seen historically. That's just my opinion, of course, not a recommendation, but that's historically proven to be true. But can you wait 10, 20, 25 years until you see some real returns on the stocks? So trading stocks, in my opinion, this is my opinion, to those who trade, forgive me, but I have to give my opinion, right? It is not a good idea, in my opinion, to trade stocks or to day trade stocks. That's a bad idea. Swing trading, I can live with that. Day trading stocks, no, or especially not scalping stocks. There's way too much money you need to commit to potentially get some sort of reward, and the tax system is set up sort of against you when you're trading stocks. So you don't want to do that. Take a look at how commodities or futures are taxed versus how stocks are taxed. So you can get in and out of commodities in a second, and the tax benefits are clear versus when you compare that with stocks. And so you do want to take a look at that if you're serious about this. So yeah, if you have $1 million or more that you can commit to the market of excess capital, then I believe 2023 is the right year to start those operations. Build your own system, and I myself can build a strategy for you under your own firm's name. So it would be your own strategy, in essence. You would have all the rights to it and make it exclusive. if you would like to do that, you can have exclusive rights to the actual license, and you'd be able to use that strategy to do whatever you need to do. And so it would be your own strategy in your own name. And so I'd be happy to build that. I'd also be happy to assist you in figuring out the landscape of getting into the money management business. But the first step would really have to be building the system, testing it, putting your own money at risk, and running it on that system and watching how it performs for at least 6 months before going and starting the actual pool fund or the CTA fund, so that you can actually manage money for others as well, because you do want to build up a track record of what you've done. And I can even show you where emerging managers go to meet and to other investors that are looking for emerging managers, because like I said, these guys are going to see, in my opinion, they're going to see an exodus. Okay, they are probably right now in tremendous panic mode. They got it completely wrong. It's very embarrassing. Okay, and I say this because I used to work here. Okay, I used to work at B of A. I spent 7 years of my life there. I can tell you just from the executives that I've known over the years over there, they're in complete panic mode. Okay, they're gonna be. I haven't talked to them in years, but just from what I know of them, they're going to be in total panic mode, okay, including on their real estate side. All these banks have their real estate side. The real estate side, because of interest rates, is in panic mode as well. What happens if interest rates keep going higher? What happens if people are unable to pay their mortgages, and we face something like we did in 2008? Probably won't be as bad as 2008. That's just my opinion. But what if it gets close to that level where many of them, I mean, just take a look at what Blackstone has done when it comes to real estate investing. Okay, they're not the only firm. Many firms have invested in the real estate market. If that takes a serious downturn, the valuation of those assets becomes a real problem for them. If one of those committees decide to start selling those assets, I mean, it can get bad really quickly. Very quickly. Okay, that would make it worse than 2008, in my opinion, if they made a decision to start unloading. Okay, so if operations internally get bad for these firms that invested heavily on real estate, it becomes like a domino effect, one thing leading to another, and it all comes down. Okay, or maybe a better description would be a house of cards. Okay, it come tumbling down. You just have to pull one card, and that's it. The whole thing falls apart. And so, it can get bad very quickly, and that is why I think, at least for the next year or two or more, depending on what happens, not much more likely, but at least the next year or two, it is going to be, in my opinion, a systematic day traders market. Now, some have said, when I say that, they reply back and they go, well, has it not always been a systematic day traders market? No, not really. It's always been a algorithmic markets, not always, but since 2008, after the crash, many of the funds, including some of the people you see here, and more famous ones now, like Citadel, and I know famous, maybe I should say infamous, like Citadel, basically, like Ken Griffin started Citadel with, I think, about $4.5 million. That's all it took to start Citadel, and now they're managing billions of dollars. He has 2,600 employees, so even Ken Griffin didn't start out, with billions of dollars AUM. He started out with $4.5 million, okay? And he grew that business, because that is the type of business that I think people that have this kind of money, 100 million to 500 million, or obviously 500 million or more, are going to look at those types of solutions, but bring it in-house, okay? Because to give out 2% or 20% performance fee to these guys, to give them 2%, and you're letting them, let's say, 100 million only. I mean, why give them that kind of money? For what? You're giving them $2 million for what? To manage $100 million and lose money for you? Does that make sense? So I don't think that's feasible for these types of firms going forward. I think the smart thing to do would be to generate, or not to generate, but to build your own system under your own name, license it out only to you, so that it's exclusive only to you, and essentially be able to trade with that system. And if it does well, God willing, then you can start your own fund, you probably have to charge a little bit less at the beginning, okay? Maybe 1% management and maybe 10% performance fee, something like that, until you build a name for yourself, okay? So I do see thousands of companies forming. I myself have received inquiries from startup funds, and so, or those that are trying to start a fund. And so I think that this is going to be the year. I think 2023 is going to see a lot of potentially thousands of new funds come into play. And so that is, I think, the kind of shift in the paradigm of money management, of the money management industry, that we're going to see. And to my viewers here, to my followers, I know some of you are in that boat as well, where you can start that type of a fund. I encourage you to look into it. Don't let this video be like the only video you research. You should definitely be researching to see if this is something that you want to do. If I can be of any assistance, let me know. I can certainly help develop strategies. I can put the strategy in your name, and I can also guide you as to what you need to do logistically to set up a fund when that time comes. If you're going to start your own fund, you have to really think about, how can I best make money for other people? That has to be the viewpoint, right? That has to be the objective. That has to be the vision. How can I do my best to make money for others? Then you can make money. Okay, that makes sense because that seems fair and equitable. Okay, it doesn't seem fair if the only view that you have is how can I make money, right? Because, we've seen so many people in the market, particularly in the crypto industry, implode by having that type of a viewpoint, okay? That's not the right way, and it simply won't last long term, because ultimately the truth catches up, okay? The truth will always come out. And so that is what's going to happen if you don't have the right viewpoint. That's just me, in my opinion. But I hope this video has been helpful. I hope and I pray that 2023 is a good year for all of us, that we have health, we enjoy happiness and joy with our loved ones, and we are prosperous and successful in what we do. Until next year, take care of yourselves and God bless.